I've been doing this for 35 years. And most of my, let's say the first half of my career, with gold under $400, back then an American Eagle gold coin would have cost roughly 6% over the price of gold. So let's just ballpark it at 6%. With $400 gold, that's 4.25 for a gold eagle. And even if you were paying a 15 or 20% premium for a 63 or 4 grade Liberty, even call it $20 or 20% premium, which is what they were most of my career on average. A 20% premium on $400 gold is $480 versus $425. So for a $55 premium, you were able to get a coin that was 100 plus years old, that had safety from confiscation, had better upside potential, was a true piece of Americana. Just a cooler thing to own in my mind, and nobody bought gold bullion. Nobody. Until I got to 2008, when it became obvious Obama was going to win. All of a sudden, the premiums went parabolic. And I will tell you that I flew all around the country, as I probably said on your show a week or two ago, for 2 years, buying back numismatics and selling them to the auction galleries like Stax and Spectrum and Heritage. They were paying massive premiums, huge premiums, 60, 70, 80, 90%. And I would call people up and say, look, you know, I sold you 500 of those 63 Liberties, and maybe a 20% premium to spot. I'd like to fly out to your house and bring you 850 gold eagles. It's never happened before. And what I learned in that trade, which to me, there have been a couple big ones I've done similar to this, in even from Swiss francs into gold and other things, but they all center around one thing, and that is recognizing and exploiting price anomalies. Anomalies, even those that stay in force longer than one would expect. You know, the old market adage, markets can stay irrational longer than you can stay solvent, but exploiting those anomalies really has been, I think, the cornerstone to the success of the largest trades I've ever done. The ones that benefited my clients more than anything. And I think it's the old adage, this time it's different. But, you know, when you talk about historical averages, normally it's not different. We could use silver right now as that example. It's staying way out of whack longer than any of us would have thought possible. And I think it is the most undervalued asset as a result of it. But in looking at the numismatics, the reason that I did not recommend them for the entire time that you and I have been talking, for over 4 years, other than at one point we did some circulated coins, never went into the uncirculated because they were too expensive. And I have looked at the world as a world that is becoming increasingly more frightening. And I don't say that, I say it in the respect of looking at through my kids' eyes. You have grandkids now. And when you try and, you know, think about what's the world my grandkids are growing up in, we want a world of opportunity and peace and prosperity. And for the last, you know, many years, I think, have questioned what is the reality of that? What are those prospects? And instead of buying coins that were collectible, trading at high premiums, I favored getting as many ounces as possible while at the same time, you know, maintaining your liquidity. Instead of buying a 10-ounce gold bar, buy 10 gold eagles. You're way better off. Anyways, the price anomaly of these premiums coming way back. And look, I bought 11,000 plus ounces of those coins, and you're talking over $30 million worth. And so the price that I was able to offer them to our clients for was ridiculous. I mean, it was much lower than all the competitors, and I could have raised them higher, but I didn't want to do that. I wanted to pass on this opportunity to our clients. And it truly is. I mean, I did it myself, all right? I did it myself with 64 grade $20 Liberties. I traded a bunch of my own stuff for them here recently on this trade. I think it's the best trade I've seen since 2008. I'll stand by that. And there are very few opportunities that I have seen where you are able to buy a 63 or 4 grade Liberty or St. Gaudens for the same price, in essence, as a gold eagle, maybe even less as a gold eagle. That's never happened in my career, never happened. And back in '08, with a 64 grade $20 Liberty, which would have been very high back then. I mean, usually I focused on 61, 2, and 3 grade to maximize gold content while still getting the benefits that numismatics provide. I would have brought you 90% more gold, and those auction galleries would have bought as many as I wanted to sell them for almost 2 years. And so just as crazy as that was to the upside, this was equally as crazy to the downside. The word opportunity cost means, you know, what is it going to cost me above buying something like an Eagle to buy something like this? Well, nothing. Well, I've never seen that ever in 35 years, ever. And so that's why I was so enthusiastic about it. I have learned by doing this for almost 5 years that if you go online and start making statements that are not supported with reality, you end up fading into obscurity pretty quick. I would never do that. And I will tell you again, for those people who took advantage of it, your listeners and mine, it's the best value I've seen in gold maybe ever in my career in terms of premium above melt. And I think markets have a way of doing this. They have a way of moving too far to one direction, correcting, and then falling too far to the other direction before they find that perfect symmetry of where they should be. Now, I know most of what we sold. In fact, I just got a message here. Let me see what they say. We have some, but not that much. Probably not enough to continue the discussion on it. But you know, in a couple weeks, 11,000 ounces have disappeared, and I think it was overly justified, and I'm thrilled that some of your listeners were able to take advantage of it. I will go down on record as saying I haven't seen something that advantageous to the customer in a very long time, if not ever. So exploiting price anomalies it's been the key. And I can think of 5 or 6 things that I have done throughout the years, all of them centered on identification and fast exploitation of those price anomalies. So what you were just saying, they changed the law recently on reportability, dealer reportability on buyback of junk silver. Dimes, quarters, and half dollars used to be reported my whole career if you sold back 1,000 face or more. Not anymore. It has to be sufficient enough to be able to cover or to satisfy delivery on a COMEX contract. Junk silver does not qualify like a kilo of silver bar would, or 100-ounce silver bar, or 1,000-ounce silver bar. And so they pulled it out of reportability in terms of requirements by the dealer. None of this takes away the client's obligation to do the reporting. It just means we won't do it on their behalf. And, you know, that's another example. Not only is silver, you know, historically undervalued, not only is the gold to silver ratio historically out of whack, following the same thing I've just been saying, but these things are happening at a time when the biggest money in the world is rushing and scrambling to acquire physical metal and hold it themselves. I mean, and yet the public is asleep. I've never seen an environment like this ever. The things that are happening on COMEX and the LBMA, it's unbelievable. And it's almost as if this giant Ponzi scheme of rehypothecated gold and silver is coming to an end. And that's what's, you know, interesting. At the same time, you got Warren Buffett, who's sitting on, you know, 334 billion in cash. He has right now 286.5 billion of short-term treasuries. That's 91 billion more than the Federal Reserve has. And this is the greatest value investor of all time, who has no interest in holding securities. I mean, he owns some still, but it shows you his mentality. Everyone is flocking at the Trump trade, and you have the most legendary investor of all time, more cash than all but, in terms of market cap, his cash balance is larger than the market cap of all but 30 public companies in the world. What does he see? And why are we seeing such a massive drive to accumulate metal. And it's interesting too, because I asked AI, just for those people who haven't heard this, I asked AI, what would be signs of the LBMA breaking? The first thing it said was widening divergence between paper and physical gold prices indicating delivery stress. Well, it was at $82 an ounce difference. I don't know what it is now, maybe 30, 35, where, in other words, you can buy a contract in London and sell one in New York and get that arbitrage. Well, that's what a lot of people say that this is about. It's the arbitrage. And I don't believe that. Yeah, it's enticing for a trader to do that, but the cost of shipping it across the globe kind of pulls the incentive away. The second thing it said was reports of delayed deliveries or contract settlements. Well, okay, it's supposed to be T+1, it's now T+8 weeks. And the Bank of England says, well, we don't have enough trucks or manpower. Really? You don't have enough trucks and you're the Bank of England, right? You couldn't just go rent every truck from Ryder and U-Haul and whoever the hell you have to rent it from in London to do this? Don't believe it. They also say, well, some of it is refining backlogs. No, it's not. Because number 4 was major disruptions in supply chains, including mining, refining, or transportation. So check, check, check. And then the other one, number 3, was unusual gold lease rate spikes, reflecting increased borrowing costs for physical gold. They've shot through the roof. They were at 10, 20, 30 basis points. They're north of 6% now. And let's talk about lease rates for just 1 second. I'm a jeweler, and I need this contract, right? I need this gold bar to make my jewelry. And so I buy a contract, and I know that I can stand for delivery. It's going to take T+1. In 3 days, I'll have my gold. What do you mean it's 8 weeks? I have orders. What am I going to do? Well, you can lease a bar from an LBMA member. Now, the lease rates have gone parabolic from 20 basis points to 6%. Well, that doesn't make it very appealing, but okay, I'll do it. So I lease that bar, give it to the manufacturer to make my jewelry. In 8 weeks, hopefully I get my bar to pay it back, and I'm made whole. Well, okay, check, check, check. So all of these things have happened. The last one that hasn't happened would be what Tom Longo is saying, trying to blow up the LBMA and the member banks, and that many are saying that the U.S. banks are kind of flipping the script here and are going long there, which I can't validate. But the last one is banking sector instability affecting LBMA member banks or clearinghouses. So how close are we to a default? Could it really be that is what the idea was to, he says it started with the flipping of LIBOR to SOFR, and that was his signal that this was beginning to happen. And then everything he's done since, draining the gold to silver out of a situation where, if we look at give you the number, I often talk about silver, that they have 300 million ounce float trading as much as, they say 290 million, but they say it's 10 times understated. So 2.9 billion ounces of silver off of 300 million ounce float. I couldn't find gold, but I did now. And for gold, they have total of about 279 million ounces on paper stored at the Bank of England on behalf of the LBMA, of which only 36 million ounces are available, right? The float is 36 million ounces against 380 million ounces in outstanding contracts. They're about 90% short on their ability to deliver, but it's just trucks and men, right? So could it be? I don't know. It seems a little bit out there, but Tom, who is a brilliant guy, is basically saying this is his way of, in essence, blowing up this paper scheme. And if we reshore all of the gold here, I don't know. I just want people to understand that it's a whole lot more than just Trump tariffs or trying to take advantage of arbitrage, and the possibilities, whether it be gold revaluation, whether it be blowing up the banks in London who Gordon Brown sold almost all of their gold. So you revalue the price of gold. Well, it ain't going to benefit London, the UK.